The grand pivot is upon us, and a lot of people are having trouble processing it. That includes today, where the Dow advanced 138 points, S&P dropped 0.27%, and the NASDAQ tumbled 1.34%, all part of the pivot. I'm talking about the fact that inflation is already peaking, courtesy of the Fed's decision to raise short-term interest rates quickly while selling off its huge hoard of bonds in the future, most likely jacking up long rates at the same time. Suddenly, demand is softening, while supply is getting more plentiful for a host of goods and for homes. Now, as is often the case, people want to fight the Fed. Right at this moment, they can't bring themselves to believe that the party might be over. The party and the companies that have benefited the most from inflation. Think commodity producers are the highest growth stocks that are valued on cash flow or orders. Yeah, like the ones found in the now beaten down NASDAQ. Any company that's been raising prices with alacrity will soon be a stock you don't want to own. And they'll probably have to roll back those prices, unless it's something that's impacted directly by the war in Ukraine. There, like food or fertilizer. Even those are coming down a bit, though. At the same time, consumers will be the winners, whether we're talking about regular people buying stuff from a store or manufacturers buying inputs for their products. The stocks that can fly in this environment have been in a bear market for ages. They are now being freed from their shackles, and a new bull market is happening as we talk. Meanwhile, the stocks that had been leading us higher for years, a very narrow group, think FANG, the acronym I came up with, narrow, I think can bounce, was really slaughtered this week, but ultimately are going to get hammered far more than they already have been. If you want to see a living, breathing explanation of the pivot, please join the CNBC Investing Club. A lot of people did in the last day, just to watch yesterday's monthly club conference call. The whole pivot is laid out there in a very visceral fashion. How do we know what works and what doesn't work in this situation? You only need to look at history. As I started saying on this show in November, it's curtains for everything other than the companies that make real things or provide real services at a profit and then return some of those profits to their shareholders via dividends or buybacks. The playbook has worked so far so well, and I bet it will keep working now that pricing for so many important things is already peaking. And that concludes freight, as I told you this week, and packaging and homes. In this environment, you need to own companies that make stuff and do things profitably. But let's add also with stocks that remain cheap on a price-to-earnings basis.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.